Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about Union Pacific Corporation. Union Pacific owns the largest railroad in the United States in terms of both track miles as well as total revenue. Today we will be looking at the company's annual report to get a better idea of its core business. Then we'll look at the company's key ratios, perform a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if you were to invest in Union Pacific at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Union Pacific Corporation.
Hey guys, let's start off by looking at the Form 10-K, which is the annual report that Union Pacific Corporation filed with the SEC. This is for the fiscal year that ended December 31st, 2020. And on page 7 of the report, the company talks about its operations. It states that the railroad, along with its subsidiaries and rail affiliates, is its one reportable operating segment. Although it provides its revenue by commodity group, it analyzes the net financial results of the railroad as one segment due to the integrated nature of its rail network. The three commodity groups that Union Pacific breaks its revenue down into are bulk, industrial, and premium goods. The bulk consists of grains and grain products, fertilizer, food and refrigerated, and coal and renewables. The industrial consists of construction, industrial chemicals, plastic, forest products, specialized products, metals and ores, petroleum, liquid petroleum gases, and soda ash. And the last commodity group is premium, which consists of finished automobiles, automotive parts, and merchandise in intermodal containers. On page 29 of this report, the company further breaks down these commodity groups. For the year 2020, the bulk operating group accounted for about 32.6% of the total operating income. The industrial accounted for about 36.3% of the total operating income, and the premium accounted for about 31.1% of the total operating income. We can see that the grain and grain products along with coal and renewables brought in the majority of the bulk revenue. Industrial chemicals and plastic along with energy and specialized markets brought in the majority of the industrial revenue, and intermodal brought in majority of its premium revenue. Finally, Union Pacific provides us detail about its average revenue per car. For the year 2020, the food and refrigerated along with forest products were the two segments that brought in the maximum revenue per car. Now that we have a better idea of Union Pacific's business, its revenue breakdown, as well as its three commodity groups, let's focus on the company's fundamentals by reviewing its key ratios. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at Union Pacific Corp. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company makes from sales. Back in 2011, the company's revenue was about $19.5 billion. It grew all the way to about $24 billion back in 2014, and for the year 2020, it's about $19.5 billion. When we look at the past 10-year trend, we can see that the revenue has always fluctuated between $19.5 and $23 billion. Next, looking at the operating income. The operating income is the amount of money that's left with the company once it has paid for the cost of goods and operating expenses. Back in 2011, the company's operating income was about $5.7 billion, and for the year 2020, it's about $7.8 billion. Throughout the years, the company's operating income has fluctuated from a low of $5 to a high of $9 billion. Next, looking at the operating margin. The operating margin is the ratio of operating income to the revenue. Back in 2011, the company's operating margin was about 29.3%, and for the year 2020, it was about 40%. Ideally, we want the company's operating margin to be staying steady or increasing, as that means that the company is doing a good job at managing its costs and being efficient with getting profit from its core business. And that is the case that we see with Union Pacific, as Union Pacific's operating margin has been increasing throughout the years. After that, we have the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, Union Pacific's net income was about $3.2 billion, and for the year 2020, it was about $5.3 billion. Over the past 10 years, the company's net income has slowly been increasing. There was a unique year back in 2017 when it reported an inflated net income number. This is because back in 2017, the company had to sell some of its non-operating assets, causing it to report a higher inflated net income number. Next, looking at the dividends per share. Back in 2011, Union Pacific paid out about 96 cents per share as dividend, and for the year 2020, it paid out about $3.88 per share as dividend. Union Pacific has been hiking its dividend every year for the past 10 years, and that is certainly something that we want to see as shareholders. We want to be invested in companies that is hiking its dividend, that way we can get more of our money back in the form of dividends. Next, looking at the shares outstanding. Back in 2011, the company had 980 million shares outstanding, and for the year 2020, it had about 679 million shares outstanding. The company's shares outstanding have been decreasing every year for the past 10 years. which tells us that the company has been buying back its shares, which helps increase the existing shareholders' ownership within the company. After that, looking at the book value per share, the book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, the company's book value was about $19 per share, and for the year 2020, it's about $26 per share. Over the past 10 years, the company's book value per share has always been positive, which tells us that the company always had more assets than liabilities on its balance sheet. Finally, looking at the free cash flow, the free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, the company's free cash flow was about $2.6 billion, and for the year 2020, it was about $5.6 billion. Over the past 10 years, the company's free cash flow has been positive and mostly trending upwards. I will be using the past 10 years of free cash flow for my expected rate of return calculation, and I will be using the 2020 figure of $5.613 billion for my discounted free cash flow DCF analysis. Unlike the net income, which is an accounting number, the free cash flow is an economic number. In other words, the free cash flow tells us how much money is actually generated from the core business. If we were to buy a company, the free cash flow would give us an idea of how many years would it take for us to recoup our money and break even. In the case of Union Pacific, we know that the current stock price is about $211 per share, and the free cash flow per share is about $7.43 per share. So if we divide 211 by 7.43, we get about 28.7. What this means is it would take us 28.7 years to break even, assuming that the free cash flow does not increase or decrease in the future years. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line. So it is a ratio of the company's net income to its revenue. Back in 2011, the company's net margin was about 16.83%, and for the year 2020, it's about 27.38%. What this means is for the year 2020, every $100 that the company made in sales, by the time it paid for the cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $27.38 left as pure profit. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities who had a return on equity of 8% or greater every year for the past 10 years. Back in 2011, the company's return on equity was about 18%, and for the year 2020, it's about 30%. Every year for the past 10 years, Union Pacific's return on equity has been greater than 8%. After that, looking at the return on invested capital, the return on invested capital gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Every year for the past 10 years, the company has provided a return on invested capital that was greater than 13%. Union Pacific's weighted average cost of capital, which is also known as the hurdle rate, is about 8% right now. And given that the management is generating a return of about 13.74% on their investments, tells us that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage compares the company's income to its interest obligations. It gives us an idea of how many times can the company pay off its interest obligations in a calendar year. Benjamin Graham preferred to only invest in securities who had interest coverage of 5 times or greater. Back in 2011, Union Pacific's interest coverage was about 10.2 times, and for the year 2020, it was about 7.12 times. Every year for the past 10 years, the company's interest coverage has been greater than 5 times. Now let's look at the financial health of the company, focusing on the liquidity ratios, starting off with the current ratio. The current ratio compares the company's current asset to current liabilities. Ideally, we want to see the company's current ratio to be greater than 1, as it tells us that the company has more current assets than current liabilities, telling us that the company has enough oxygen in its system to survive for another 12 months. Back in 2011, the company's current ratio was about 1.12 times, and for the latest quarter, it's at 1.01 times. For most of the past 10 years, the company's current ratio has been greater than 1 times. Next, looking at the financial leverage. The financial leverage is a ratio of the company's total assets to its shareholders' equity. A higher financial leverage number tells us that more of the company's assets are financed through liabilities. Ideally, we want to see the company's financial leverage to be staying steady or decreasing. Back in 2011, the company's financial leverage was about 2.43, and for the year 2020, it was about 3.68. The company's financial leverage has been increasing since 2017, and this tells us that the company has been taking on more debt, and its liabilities section on the balance sheet has been increasing. Finally, looking at the debt to equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want to see the company's debt to equity ratio to be less than 1. Back in 2011, the company's debt to equity was at 0.47, and for the year 2020, it's about 1.59. Union Pacific's liquidity and financial health ratios are comparable to its competitors such as Norfolk Southern and Canadian Pacific Railway. Finally, let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Union Pacific's PE is at 26.8, whereas S&P 500 is at 27.9. Next is the price to book. Union Pacific is at 8.3, whereas S&P 500 is at 4.0. Next is price to sales. Union Pacific is at 7.3, whereas S&P 500 is at 2.9. After that, price to cash flow. Union Pacific is at 16.8, whereas S&P 500 is at 16.3. And finally, the dividend yield. Union Pacific has a dividend yield of 1.8%, whereas S&P 500 has a dividend yield of 1.6%. From all these valuation metrics, we can see that Union Pacific's current valuation for the most part is in line with that of the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Union Pacific. Over here, I pasted the 2020 free cash flow number that I got from Morningstar, which is at $5.613 billion. I'm using an annual growth rate of free cash flow to be 6%. What this means is I expect Union Pacific's free cash flow to grow at 6% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I expect Union Pacific investment to give me a 10% return. I'm using a long-term growth rate of 4%. What this means is I expect Union Pacific's free cash flow to grow at 4% every year from the 10-year mark into perpetuity. The company has 679 million shares outstanding and has a long-term debt of $25.66 billion. After taking into account all these inputs, we get the intrinsic value to be about $125 per share. When we compare this intrinsic value to the current stock price, we can see that the current stock is trading about 68% above the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum all those up, which come out to about $46 billion. Then we look at what the free cash flows would be from the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $110 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $125. Now, if we disregard the perpetuity component, in other words, if we think that Union Pacific's free cash flow will only grow for the next 10 years and then the company will just cease to exist, then we get the intrinsic value without the perpetuity to be about $30 per share. And if we disregard both the debt and the perpetuity, then we get the intrinsic value without the debt and perpetuity to be about $67 per share. Finally, if we drop the discount rate to 8%, which is in line with the company's weighted average cost of capital, also known as its hurdle rate, then we get the intrinsic value to be about $212 per share, which when we compare to the current stock price of $211 per share, would make the stock neither under nor overvalued. Hey guys, now let's look at the expected rate of return calculation for Union Pacific. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get over the years. We can see that the free cash flow has always been positive and is trending upwards. Next, looking at the future data and predictions, I'm assuming that there's a 35% likelihood that Union Pacific's free cash flow will grow at 6%. There's a 50% likelihood that its free cash flow will grow at 4%, and a 15% likelihood that its free cash flow will grow at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is at 679 million shares, at the current stock price of about $211 per share, we get the expected rate of return to be about 3.3%. What this means is if we were to invest in Union Pacific at the current stock price of about $211 per share, we can expect to get an annual return of about 3.3% if we were to hold this stock through 2060. Hey guys, now let's wrap it all up. We reviewed Union Pacific's revenue breakdown and its three commodity groups being bulk, industrial, and premium. We saw that the company's revenue, operating income, as well as net income for the most part has been staying steady or increasing. Its operating margin has been increasing, which tells us that the company is getting better at managing costs and getting more profit out of the core business. Union Pacific has been hiking its dividend every year for the past 10 years and has been buying back its shares every year for the past 10 years. Both of these things indicate that the company is returning value to its shareholders in the form of dividends and buybacks. Union Pacific's return on equity has been greater than 8% every year for the past 10 years, and its return on invested capital has been greater than its weighted average cost of capital, which tells us that management is creating shareholder value. Every year for the past 10 years, the company's interest coverage has been greater than 5 times. After that, we looked at the company's financial and liquidity ratios and saw that Union Pacific's current ratio, financial leverage, and debt to equity ratio were comparable to its competitors such as Norfolk Southern and Canadian Pacific Railways. Next, we saw that Union Pacific's current valuation is in line with that of the S&P 500. When we performed the discounted free cash flow DCF analysis using a 10% discount rate, we got the intrinsic value to be about $125 per share, And when we use the 8% discount rate, which is in line with the company's weighted average cost of capital, the intrinsic value came out to about $212 per share, which is in line with the company's current stock price, making the current stock neither under nor overvalued. After that, we saw that if we were to invest in Union Pacific at the current stock price of about $211 per share, we can expect to get an annual return of about 3.3% if we were to hold the stock through 2060. Finally, the post-COVID infrastructure spending, along with the strength in housing, could fuel a greater haul of lumber, steel, and other industrial goods. With stronger regulatory scrutiny on oil and gas pipelines, more crude oil is likely going to be transported via rails in the future, making Union Pacific's energy-related sales volumes and traffic increase. In conclusion, Union Pacific is a strong fundamental company. It has a stable dividend and buyback program. Even though the current stock price is fairly valued, Union Pacific is a conservative long-term investment. Hey guys, that is all I have for you this week. Hopefully you found this video on Union Pacific interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.